Hi, welcome to my channel. In this video, we are coming to look at budgeting and forecasting as a tool for decision making and control. If this is your first time on my channel, please subscribe to the channel and consider sharing the video if you find it useful. If you are already a subscriber to my channel, thank you very much for your time. I really appreciate your time here. Please consider sharing the video with others so they can also benefit from what you are coming to learn in this video. So in this video, we are coming to have an overview of what a budget is, which I am very much aware a lot of you are already aware, how it is different from a forecast, and then we are going to talk a little about the different approaches to budgeting, and then we are going to look at what we call the principal budget factor, and then finally we are going to look at the functional budgets, and then we are going to wrap everything up with the preparation of the master budget. So we've got quite a lot in this video, so let's get started. Now, what is a budget? A budget is usually the plans of a firm or a company or of an individual that is expressed in financial terms. Alright, so when you express your plans in financial terms, we are referring to it as a budget, as simple as that. So when you express your plans in financial terms, we are referring to that as a budget. So a budget is simply your financial plan that outlines or details what you expect to earn and then what you expect to spend over a period of 1 year. That is what we call a budget. Alright, that is the simple definition of a budget. There is no complication to this particular definition. And then secondly, we want to look at how a budget is different from a forecast. Alright, now what is a forecast? A forecast usually involves predicting. You are making a prediction into the future about how things are going to happen. So when you prepare the budget is usually for a longer term, so for a whole year. And then this budget is going to be broken down into weekly, monthly, or quarterly sections, so that you can easily track what your actuals are vis-a-vis the budget. So when you are doing that, as soon as you are able to break your budget into these different weekly or monthly or quarterly budgets, so to speak, then you are doing what we call forecasting. So a forecast is usually for the shorter term, whilst the budget is for the entire year. Alright, so that is the difference between the budget and then the forecast. When we look at the budget, you can see the budget here. Then in the course of the year, you'll be comparing your performance with the budget, and then you'll be setting what variances. You'll be looking at the variances, and that is what you are calling a forecast. All right, so the forecast is usually predicting what the future trends are, what outcomes are, and then this is usually based on what has happened in the past. Alright, so that is the simple difference between a budget and then the forecast. So simply put, the budget is for the longer term, and then the forecast is for the shorter term. And it can be weekly, it can be monthly, or it can be quarterly. And the forecast helps us to adjust the initial expectations contained in the budget. That is simply the difference between a budget and then the forecast. And then what are the approaches to budgeting? I have listed some of them here. The first one here is the incremental budgeting. The first one is incremental budgeting. Now, what do we mean by incremental budgeting? It is that form of budgeting which involves making adjustments to previous period's budget by adding or subtracting certain percentages or amounts. Alright, so that is what we call the incremental budget. So you have you want to prepare the budget for the next year. What you do is that you will pick that of the previous year and then make adjustments to those figures. That is what we are calling incremental budgeting. Then the zero-based budgeting is the opposite of the incremental budgeting. Here we are not making any adjustment to previous figures. We are building the budget from scratch. So we are literally justifying the inclusion of the items that are going to be included in the budget. All right, so we want to justify every item that we want to include within a particular budget. That is what we call the zero-based budgeting. So we have to thoroughly review the expenses, the revenue sources. We have to review them, and then we are going to look at whether these are qualified to be included in our forthcoming budget. All right, so that is the zero-based budgeting. Now we have the rolling budget, or what we call the continuous budgeting. So the rolling budgeting involves continuously updating the budget throughout the period by adding a new budget period as soon as the previous or the current year's budget expires. All right, so with this, what you're saying is that it allows for flexibility and adaptability to changing circumstances. So you have a current budget, let's say it covers the 4 quarters of a particular year. Then when the first quarter expires, you add a new budget. So at every point in time, you have the 4 quarters in place. All right, so that is what we call the continuous budgeting. So when one period expires, a new budget is prepared, and that replaces the expired period, and it continues like that. All right, then finally we want to look at the activity-based budgeting. With this kind of approach, what you are saying is that we are allocating resources based on the expected cost of activities that are required to achieve the particular objective that we are trying to achieve. All right, so it focuses on the relationship between activities, resources, costs, and enabling better cost control and resource allocation based on value added services or activities. Now, this kind of budget is one of the newest form of budgeting approaches, and we are talking about the activities that drive the cost and then the sales. The various activities that drive the cost and the sales, that is what you are basing the budgeting on. All right, so when you're preparing the budget, you regard the activities that drive the cost and then the benefits or the revenue or income outlined in the budget. All right, so these are some of the approaches to budgeting. So we have the incremental budgeting, zero-based budgeting, rolling or continuous budgeting, and then we have the activity-based budgeting. Now, what is the principal budget factor? In budgeting, we are considering our resources that we have, we are considering our capacity, and then also we are considering the amount of cost that we want to incur during the budget period. Now, all of these are limited by a particular factor called the principal budget factor. Now, the principal budget factor, also known as the key budget factor, is that element in our budget, okay, that sets a limit to the level of operations or activity within the budget. Okay, so it is that particular critical element within the budget that sets a limit to the volume or the level of activity or the level of operations of the budget period, and for that matter the organization or the individual, if the budget is for the use of the individual. All right, in my next video, I'm coming to look at how we can prepare personal budgets. All right, in this particular video we are going to look at budgeting for companies, and we are considering a manufacturing company for that matter. All right, so that is the principal budget factor. What this does is that when you are able to identify the principal budget factor, it is so key that it can help you to make your budgeting decisions by prioritizing resource allocation and guides management in optimizing their performance within the constraints imposed by this particular key budget factor. All right, so by focusing on the key budget factor, the organization can make informed decisions as to how to maximize their effectiveness and then their efficiency. All right, so that is a brief overview of the principal budget factor. And this principal budget factor is usually the sales. All right, it's usually the sales volume, because the amount of sales you want to make for the year will determine your production level, will determine the amount of labor you want to use. It will determine all other costs. All right, because the ultimate goal is for you to have this level of sales. All right, so the sale level is usually the key principal budget factor. All right, so let's look at the functional budgets. All right, in this particular, in the rest of this video. So we are going to look at the functional budgets. And when you are talking about the functional budgets, we are talking about the various kinds of budgets that we can prepare for a company. And to do that, we are going to use a scenario which I have here. So we have the scenario here, and we are going to use the scenario to prepare the functional budgets. And then after that, we'll prepare the master budget. The master budget. So we are going to use the scenario to achieve the rest of the objective of our video. All right, so let's get started. So we have Get Plus company manufactures two products known as UG and PG. UG is produced in Department 1 and PG in Department 2. The company is preparing the annual budget for the next year based on the following budgeted information. So we have material X using $7.20. So these amounts are in dollars. Let me put my dollar sign here. All right. So I'll put my dollar sign there. Then we have material Y. So the product, to manufacture the product, we need material X, and it is selling at $7.20. The material Y, which is also needed, is selling at $16 per unit, and then our direct labor cost per hour is $12. All right. Then we have overhead is recovered on a direct labor hour basis. Now this particular scenario relates to a manufacturing firm. As I said in the beginning of the video, that we are going to consider the budget for a manufacturing company. Now this is for a manufacturing company, but it applies to all other companies. The approach is the same, just that the terminology is what is changing here. So in my next video, we are going to look at how to prepare the personal budget, and then we will see how that plays out. All right, so we have overhead is recovered on a direct labor hour basis. Take note of that. So we have standard material and labor usage for each product as follows. So for model UG, that is our product, we will have material X using 10 units, all right, of our labor hour, and then model PG is going to use 8 units. Then for material Y is going to use 5 for UG, and then PG is going to use 9. Direct labor hours, 10 hours for UG, and then 15 hours for PG. Then we have a balance sheet for the previous year. So this tells you that this is an example of an incremental budgeting approach. So we are going to use the incremental budgeting approach because we have figures from the previous period that are going to adjust in the current period. All right, so that is what we are calling the incremental budgeting. So we have fixed assets at cost. So we have the land at cost there, which is not depreciated as usual. We have buildings and equipment, 1.292 million. We have the depreciation elements being deducted to get our net book value there, and then this is added to our land figure, and then we have our fixed asset figures to be $1,207,000. all right, then we have our current assets. We have inventories, that is finished goods. We have raw materials, inventories, and then we have our debtors, and then we have our cash. All right, then we will less our current liabilities from the we'll less our current liabilities from the total current assets figure here. So this is our current liability, so less it from the current asset figure to get our total net current assets, which is also known as our working capital. And then we add this working capital to the total fixed assets to get our net current or net assets for the period. And then we have represented by shareholders interest, that's 1.2, and then we'll have our reserves also at $369,476, also making the total here. So that is for our balance sheet. Then we have other relevant budgeted data for the year as follows. So we have our forecasted sales, our forecast sales in units. So for model G and then model PG, all right. So our selling price per unit is also given to us. Then the ending inventory required in units for UG and then for PG. And then we'll have our beginning inventory units 170 and 85. This, I'm just reading the question, so don't be nervous, calm yourself, and then you are going to get right into what you are going to do. You will get everything here, so just relax, and then we are going to do everything together. So we have direct material information here. So the first one is for finished goods, all right. Then these are for our direct materials. Let me center align this, all right. So we have our beginning inventory units 8,500. We have material Y to be 8,000. For the ending inventory, we have material X to be 10,200, and then for material Y is 10,700. Then budgeted variable overheads rates. We have indirect materials. These are in dollars, all right. So this is for department 1, and then this is for department 2. So we have the indirect materials, indirect labor, our power usage, all right, the variable portion, and then maintenance expenses, also the variable portion here. Then for these, each of these items, we have their fixed overheads as well. The first information here is the variable overhead rates, all right. Then these are for our fixed overheads. So for the fixed overheads, also divided into departments. We have depreciation, we have supervision, we have power, the fixed portion, and then we have the maintenance, the fixed portion. Then lastly, we have some information here: estimated non-manufacturing overheads. Estimated non-manufacturing overheads. Overheads are simply our expenses, indirect expenses, all right. So those are our overheads, indirect expenses. So we have stationery, that is incurred in administration, all right, at $4,000 here. We have salaries, we have our salaries, and the salaries we have for sales department 74,000, and then the office 28,000. Then we have commissions. We have paid commissions to our sales people. Now remember, these are all estimates, all right. They are all estimates, remember. So we have commission 60,000, car expenses that is relating to sales, okay, 22,000, and then we have advertising 80,000, miscellaneous expenses in the office 8,000, totaling 276,000. All right, so those are our non-manufacturing overheads. We are going to use those within our selling and administration budgets. All right, so just relax. We are going to look at how we are going to use each and every one of these items within our budgets. Then finally, for the scenario, we have our budgeted cash flows information as follows. Now this is usually as usual is divided into quarters. We have quarter 1, quarter 2, quarter 3, quarter 4. All right, so what do we have here? We have receipt from customers, then we have payments for materials, payment for wages, and then other costs and expenses. So this is the scenario. We are going to use this scenario to prepare our functional budgets. So as we are preparing them, then I'll be explaining what the functional budgets are, what individual functional budgets contain, and all that. All right, so let's go on. All right, so let's get into the functional budget preparation. All right, so the first one is the sales budget. All right, the sales budget. So this is a budget, so I'm coming to make it a bit nice here. So what I'll do is, let's give it a very nice let me give it this, and then I'll have my sales budget for the period. So I want to change the font color to white. All right, and then let me also enlarge this and merge everything together. Good. And then I'm going to center this into middle, align that, and then what I'm going to do here, and also increase the font size a bit. Okay, so we have our sales budget for the period. Now, what is the sales budget? The first functional budget we are coming to consider is the sales budget. Now, we are considering the sales budget because, as I said, in this particular scenario, or generally for manufacturing or even some service firms, the revenue level that you want to earn sets as the key budget factor. So when you know your level of sales, then that will inform your production, that will inform your costs, and that will also inform any other thing that will help you to achieve your level of sales that you have projected. All right, so that is the reason why you are considering the sales budget. So what is the sales budget? It shows the quantities of each product, all right, that the company is planning to sell, and the intended selling price. So it contains two things: the quantities of product you want to sell at their selling prices, and that will give you your revenue, your projected revenue. All right, it's as simple as that. So it's, and this, because it's the principal budget factor, it serves as the um, it serves as the foundation for the preparation of all the other functional budgets. It is serving as the basic data for the preparation of all the other functional budgets. All right, so that is what we've got there. So to be able to make your sales budget, usually what we do is that we do a thorough market research for us to be able to determine the budgeted sales level. All right, so that is what we do in practice. All right, so we have to research the market to see, okay, considering the level of competition, considering the economic level, considering the market situation. Okay, so we are suggesting that we produce and sell this amount of products. All right, so that is what we do in practice. All right, so, and usually we prepare the budget, as I said, on usually on a more shorter period, but for our scenario we are going to prepare the budget for the whole year. So typically you can have the sales budget for monthly. All right, so you can have it for January, March, April, like that, or you can have it quarterly. All right, depending on how you want to track your sales and all that. So that is what we've got there. So what we have here is, I'm going to have product. All right, and then I'm going to have the units that you want to sell. So units sold. I'm going to have my selling price. I'm going to have my total revenue. So quickly, let me adjust all of these figures. So I can come here and adjust my figures. All right, so let me delete this and see. Okay, that's perfect. So what we've got there is that, what products do we have? Okay, so let me cut this, actually paste it from the beginning here, and then let me adjust all of these. So we can actually undo this, and what we want to do is to make it a bit nicer. So what I'm doing is to try and readjust this so it fits whatever we are doing here. Alright, so quickly let me delete these ones. Okay, so that is what we've got there. So what is our products? The products are UG and then PG. Alright, so we have UG and PG. Then from our scenario, we have the budgeted sales figure here. So let's scroll down. So this is our forecast sales. Alright, so we have budgeted the following for the next year. The other relevant budgeted data are as follows. So what have we budgeted? We have budgeted that after our market research, we have budgeted that we are going to produce 8,500 units of UG and then 1,600 units of PG. Alright, so those are our models prediction. So what we have here is that the units sold, I'll come here, come to the scenario tab, and then I'll select my UG sales, come here, come to my scenario, and then pick my 1,600. Then what are the units sold? The units price. We've been given those here. The selling price per unit for UG is 400. So I'll come and pick here and then pick that. I'll come here and then also pick this one as well. Alright, then the total volume or the total revenue is going to be the selling price multiplied by the units sold. So we've got that. I can copy the formula down using Ctrl D, and then I want to format this as just like that. So I can come here and have my total there. So alt equals to give me my total. So that is our total sales. So let me come here and write my total. So just like that, we have our budgeted sales nicely presented for us, just like that. Alright, so that is it. Let's do a bit of formatting here. So we got this. Nice. So that is our budgeted sales for us. Then the next one we want to do, actually I wanted to put them on different pages, but I think considering the level of work that we're going to do by flipping back and forth, let us put it right here. So the second one, now that we have determined the sales budget, we can now be informed about how much we want to produce. So quickly we are going to the production budget. Okay, we are going to prepare the production budget. So we'll have I can copy this formatting here and then can come in paste special. So that is Control Alt V, that is paste special, and then I'm going to paste the format right there, and then I'll have my production budget. I'll have my production budget for the year. Then for the production budget, what this does is that after we have determined our level of sales, what we want to do is to determine the quantities that is going to be produced to be able to make this level of sales that we have projected. Alright, so we are going to determine how much we want to produce for us to achieve our sales target. Alright, so that is what we do, and the production budget is usually prepared by the production manager. They are responsible for the preparation of the production budget. Alright, so this is to ensure that sufficient level of products are available to meet the sales demand, and then also to ensure that our inventory levels are always kept at minimum, okay, so that we don't overstock and then we also don't understock. All right, so that is what we have for our production budget. So how do we prepare that? We are going to prepare it on department basis. Okay, so we have our departments, department 1, and then we also have department 2 here. Then what we've got here, we know that department 1 is for the production of UG, whilst department 2 is for the production of PG. Alright, so when I say department 1, you can actually also put the product names here, and that refers to the departments as well. So let's come to our scenario. What we've got there is that we are coming to look at our production level. So how much are we supposed to sell? We are planning to sell this particular amount, so that becomes our baseline, or that becomes our base production level. These two figures here, which is the units to be sold, becomes our baseline production level. So quickly I'll come here and then I'll write units to be produced, and this will give me 8,000. So quickly let me refer to this. I quickly refer to this so that it makes everything dynamic. So I'll come there and then I'll also refer to this one as well, 1,600. So that's what we've got there. And then what we are going to do is that we have ending and then beginning period inventories. So what we do is that we are going to add the ending inventory period. Okay, how much are we supposed to, or how much are we planning to leave in store by the end of the year? We are going to add it to the units we are coming to produce. All right, so we will have at the end of the period how much of the inventory is going to be left in stores. So we will have our closing inventory. All right, we have our closing inventory for the period, and that is the budgeted. Sorry, let me correct this typo here. So it's actually the budgeted closing inventory for the period. So what do we have here? We will come to our scenario and then we will be given the budgeted closing inventories. So for UG is 1870, and then for product PG it is 90. So 1870 and 90. So I'll come here. Sorry, so let me quickly delete this particular in there. Okay, so we'll have the product here to be so we have this 1870 for products UG, and then for PG it is 90. So we have 90 there. All right, then we want to continue. So we have after getting that, we can add these two together. So I have my alt equals to add those, and then I can use Ctrl R to copy to the right. Then I'm going to less, because we've added the closing inventory, which is the amount we have budgeted to remain in stores. We are going to add it to our production. Then what do we have? We are taking away what we have left at the ending of last period, which becomes the opening inventory for the current or the next period. All right, so that becomes the opening inventory. We are going to less it so that we know the amount we want to actually produce for the year. All right, so the units we want to produce, we will add what we expect to be left in store at the end of the year, and then we will subtract what we've taken from the previous year into the present period. So we'll have our less opening, so less budgeted opening inventory there. So we have our opening inventory there, and then what we've got here is also coming to be taken from here. So we have 170, and then we'll also have 85 here. All right, so if you like, you can put these in brackets So let me actually add a border here to make my presentation a lot nicer. Sorry. So let me add top border there to make my presentation nicer. Now I have less. We can actually write budgeted opening inventory and put these as negatives, so that when you add together it will what give a negative effect on our balance. All right, so we have this minus our budgeted opening inventory, and that is what we have here as 10,200, and then also 1,605 for the product PG or department 2. All right, so this is our projected or our planned production for the year. This is our planned production for the year, and then I can actually put my borders around it. All right, so that is our projected production for the year. All right, I hope you understand it. So that is the production. Quickly, we want to go to now in practice you can actually as I said, you can actually divide this into monthly basis. So each department will prepare their production. If the sales is prepared on monthly basis, then the production must also be prepared on monthly basis, all right, by each department on a monthly basis. So that is what happens in real life situations as well. But this one we are analyzing everything. All right, so quickly we want to go to the material usage budget. Now what is the material usage budget? After we have determined our production level, we are now interested in knowing what material we are coming to use to achieve this production budget. So you see how the entire thing is following. So first we determine our sales level. Our sales level informed our production level. Now our production level will determine the quantity of materials we want to use for our production. So I'll come here, and then to save time I can copy this up to here like that, and then this one I'll come to the different tab here, and then I'm going to paste that special using Ctrl Alt V, and then I'm going to paste my formats there, and then I'll hit OK. So we have something like that here. So what I've got here is the annual. We have the annual budgeted. Sorry, so we have the annual budgeted materials usage. So materials usage budget, materials usage. So I can expand that. All right, so what we've got here is that we are going to have our materials. This one we are determining the quantity of materials, and from our scenario we are looking at the use of material X and Y. So when it comes to the material usage, we are going to prepare it based on the material. So we have material X, and then we will have our material Y. All right, now what is the quantity of material that we are coming to use? What's the quantity of material we are coming to use for each of our products? So the quantity that we are going to produce will inform the material we are going to use. Now from our information here, we've been told that the standard material and labor usage for each product is as follows. So for model G, UG, we are going to use 10 units of material X to produce the quantity of units we want to produce, and then also we are going to use 8 units of material X to produce model PG or the product PG. So let's see how that's going to play out. So we'll come here, and then we'll say to produce UG, and then also to produce PG. So what we have here is that we will have equals We'll come to our production budget. How much do you want to produce? Is 10,200 for product PG or UG, sorry. So we have our 10,200 here. I'm going to select that, and then I'm going to multiply that by the quantity per unit of material X, which is 10 we have here. So I'll have that. Then for material Y, I'll come here, and then for my production level for product PG is 1605. I'm going to multiply that by my production material X units, which is 8 here. I'll hit enter. Sorry, since that didn't copy well. So it is actually my production level multiplying that. Okay, so we have material Y, and that is going to be the production level, all right, which is 10,000 for our product UG, multiplying this particular 5, which we are using for material Y. All right, so I'll hit enter, and then for PG, for producing PG, we will have this amount here multiplying the material Y item, which is 9. All right, so we have that. So quickly I can sum this together. So alt equals to sum them, and then I can copy my formula across. So this is the amount of material, total amount of material we are planning to use. All right, now the material we want to use will determine the amount we want to purchase, right? So quickly we can have our material purchased budget as well. So the next item here is going to be the material purchased budget. Material purchase budget. So quickly let me copy the format there, come down here and paste it here. So we'll remove this to produce here. We have this, and then we also have that deleted. Okay, so now that we've known how much we want to buy in terms of materials, let's actually prepare the budget for the purchases that we are coming to make for our materials. So what we've got here is that we will have our budgeted usage, and that can be found from the top right here. So we have equals this, and then this one also that. So actually I can use Ctrl R to copy that across. So that is our budgeted usage. What we have here is that how much are we going to purchase? We are going to add the budgeted closing inventory. Don't get confused, or don't confuse this with our production budget. All right, they are different. This one is considering materials. The first one we are considering the products. This one we are considering materials only. So don't confuse those two. All right, so what we have here is that we are coming to our scenario, and then we have some information there that is going to be relevant for us. So we have here now the materials information are here. We've been told that this is also the relevance under the relevant budgeted data as follows. All right, so we have our beginning inventory of direct material, as you can see at the top here. So this is direct material. So this information is what we are coming to use within the material purchased budget. All right, so this is the information. Now we are going to add the ending inventory. The same logic applies as we did for the production budget. So we are going to add the ending inventory, budgeted ending inventory, and then we are going to subtract the budgeted opening inventory. All right, so let's go. So we have equals our budgeted ending inventory for material X is this, and then I can copy that to the right, to get our budgeted inventory for the material Y as well. So quickly, let me add that before we subtract the opening inventory. So we have that there. Let me insert a border here to make it nicer. Then quickly we will have our closing budgeted opening inventory. This one I have not put less here, so what I'll do is that I'm going to put it as a minus. So quickly I'll come to my scenario and pick the opening inventory right here, and then I can copy this to the right. So we have that nicely there. So I can add the two together so that it will going to have a net effect. All right, so this is our budgeted purchases. All right, so this is the amount we want to purchase for the production of our the production level. So this is the amount of material we want to purchase in quantities. So I'll have what my total quantity of materials. Total quantity of materials. To get the amount or the dollar value of my quantities, I would have to multiply that by the per unit, the amount per unit. So quickly I'll come here and then I'll have total material price, okay, per unit. So I have my material price per unit, and that is going to be equal to, let's come to our scenario, it is right there for us to pick. So we have indirect material here, so you can actually come here and then you pick that information from here. So from here we see that our material X is selling at $7.20 per unit. So quickly I'll pick that, and then for material Y is also there. So quickly I can use Ctrl R to pick that value as well. Sorry, it's not like that. So let's go to the scenario and pick the formula manually. So I'll come here and then I'll pick that 16. So what you've got here is that I'm going to multiply the quantities by the price per unit to get my total material to be purchased in dollar amount. So let me quickly format that as this, and then I can copy it across. All right, so we have it nicely done here. So let me include my border to it. So we have that nicely done. All right, so we have the budgeted materials to be purchased as well, or to be used for our production as well. So we are continuing. We are actually doing very well. Please, if this is your first time on my channel, kindly subscribe to the channel and hit the like button right there for me to know that you are actually learning a lot from this video, and also consider sharing with others so they can also benefit. All right, so we continue to our direct labor. So after determining our materials, now people are going to use this material to produce, so you need to budget for the people as well. So we come to our direct material purchase budget. So what I'll do is I'll copy this in order to save time. Copy this, come here, and I can paste it here. Okay, so let me allow that nicely there. So the direct material labor budget. So we have our annual labor budget. All right, so we have our annual labor budget, and with this still we are coming to use our production because it's people who are going to do the production. So what we do is that this one we are using labor within the various departments. So I'll have my department 1 and then department 2. So I'll have my department 1, and then I'll also have my department 2. So what we are coming to do is that we are going to start with the budgeted production. That is going to inform the amount of labor we are coming to use. So the budgeted production, as we have already found within the production budget, 10,200, and then that. So I'll come here and then I'll have equals production 10,200, and then I can copy that across R. So we have our 10,000 and then our 1605 as our production level. And then what we have here is that we are going to multiply the production by the labor hour per unit, the labor hour per unit. All right, the labor hour per unit. So we have our labor hour per unit of production. Then we can quickly get that from our scenario. So let me come here. Now the labor hours, so for our labor hours, we are talking about this particular labor hour here. This, remember, these are dollars amounts. We are talking about the hours. So I wanted to do that for you to see well. So this is actually our labor hour. Okay, this is our labor hour. So per hour for model UG, remember UG is produced in department 1, PG is produced in department 2. So we are going to pick that and then we can copy it across for department 2 as well. All right, so that is our labor hours. Let me go back to the scenario for you to see that. So quickly, let me do this. So we have our labor hours here per unit, all right, or per unit here. Okay, so and the information here is even telling us that the standard material and labor usage for each product. So if you have determined that you are going to produce this amount of products, then this amount of production multiplying the labor hour per unit should give us our total hours we are going to use in the various departments. So this will be equal to the production level multiplied by the labor hour per unit, and that will give us our total labor hours as we've got there. So let me quickly format this as that. So we have, well, our total labor hours. So we have our total labor hours. Let me input border here for it to be nice. Okay, so we have our total labor hours. Now we want to quantify the labor hours in terms of money. So what do? We are going to multiply it by the labor hour, labor rate per hour. So remember, these are in hours. This is our total budgeted. So let me actually write it here. Total budgeted, okay, budgeted labor hours. So that is what we have here. We are going to multiply that by the labor rate per hour to get our dollar amount for the labor. So total direct labor costs. So when you multiply that by the total labor hours, we are going to get our total labor costs right there. So let's go to the scenario and link that up. So I'll come here and then I'll have my direct labor being $12 per hour. So I'll come here for all of them. So I'll come here and copy that across. Sorry. So this is also 12. All right. So quickly I'll have equals this multiplied by this, and that will give me my labor hour. Let me format this. Okay. So that is our total budgeted direct labor hour, or directed, sorry. So this is our total direct labor costs for the period. All right, so that is our total labor cost for the period. So let me quickly come here and do this, and then also wrap it around with my border here. So that's okay. So that is our labor budget for us. The next thing we want to do is to prepare the production overheads. So quickly, I'll have this here. We will have what you call the annual budgeted production overhead here, and then what I have here is that I'm going to pin this and then also center align it there. All right, and then also increase the font size a bit. Let me make it 14 is okay, and then let me increase this to that. All right, for the annual production overhead, we are coming to look at how much we are coming to incur within our production department. So this is actually the responsibility of the production manager. All right, so they prepare the production budget overhead as well. So the overhead, we are talking about all the other expenses other than the direct material and then the direct labor expenses. So all other expenses that we are coming to incur during the production period, that is what we are calling the production overhead. Now there are some of the costs that are within the control of the production department and some of the costs are not. All right, so the costs that are within the production manager's power to determine is what we call the controllable costs. Those that are not within his control or his or her control is what we are calling the non-production or non-controllable costs. For instance, costs that have been apportioned to the production department. Let's say, for instance, power is incurred in the entire organization. So at the end of the period, they are going to allocate this power usage to the various departments. Administration will get some, production will get some, and then all the other departments within the organization is going to get some. So that is what we call the non-production overheads. So what we're going to do is that we're going to separate these into the controllable and then the non-controllable systems. This is done to ensure what control. Okay, we have budgeting and then we also have budgetary control. Budgetary control comes after we have produced our budget. So once the budget period is unfolding, we will do what we call budgetary control to assess the performance of the managers of each of the units within the organization. All right, so we have that. So what we have to do is that we are going to have that within our departments. So I'll have department 1 here. So I'll have my department 1 and then I also have my department 2. Let me expand this and then also expand this as well. So we have that. Then we also have a total here. So actually let me cut this and paste it here so I can have my total here. So we have that. So what we've got here is that we are going to have our controllable overheads. As I said, overheads are talking about the indirect costs. Okay, the indirect costs incurred within an organization are called the overheads. The aggregates, when you add all your indirect costs together, that's what we are calling the overheads. It's just a costing terminology that we use within the organization. So with the controllable overheads, what we have here is that we are going to do it for each of the departments. So as I said, they are indirect costs. So from our scenario, let's go back to our scenario here. From our scenario, we have indirect costs. Now we have the budgeted variable overhead rates, and then these are absorbed on the basis of labor hour, which means that we are allocating those indirect costs on the basis of direct labor hours that we are using. Okay, because remember, all of these indirect costs are relating to people. The ones that are relating to the product are what you have seen within the materials usage, the materials purchases, and then the direct labor overheads. The rest are relating to people. All right, so we are going to do all of those things, and then we will see that. So we have our indirect materials, indirect labor, power, and then we have maintenance also here. All of these are what we are calling the indirect variable overheads. Okay, the indirect costs or the variable overheads. So I'll come here, my production overhead, and then what I'm going to do is to link all of these up to save time. So I'm going to link everything here up, and then I can copy it down. All right, so quickly we have that. That is how fast Excel can be. So let me, it's okay. So this is actually heading, so let me differentiate that from the rest. So we have the cost. Now what is going to be the cost? It's going to be the indirect material per unit here. As I said, we are absorbing the these particular items on the basis of labor hours per the direct labor hours you are going to incur. So I'm going to pick my indirect materials and multiply that by the total labor hours. Total labor hours here, and then I'll have my equal sign there. Then for department 2 as well. But let's do it for department 1 first, and then you can do it for department 2, and then we can continue. So we have a scenario for our indirect labor is this. So it's actually the same thing. So I'll come here, and then I'm going to multiply that by my total labor hours here. Let me quickly format this. Good. So for my power, we have the unit amount here multiplying the total direct labor hours as we've got there, and then for this I'm going to have this multiplying the total direct labor hours in department 1. All right, so I can have my alt equals, and that gives me that. Now let me try and see if this will copy across. So I have just copied it across and it works perfectly. Then the total is going to be equals to, so alt equals there, and then I have my total controllable cost here. So let me bold this and then also put this by that. Okay, so we have our controllable cost. Now we can go to our non-controllable costs. Now we can go to our non-controllable costs. Let me use the word overheads as we are using. So non-controllable overheads, put by this here. Okay, so it's going to be the same thing. So quickly, let's go to the scenario and see our non-controllable overheads. For those ones, those are the fixed overheads we have here. These are the fixed overheads. So we have depreciation. The production manager is not responsible for depreciation. Supervision, which is done by the supervisor, which is different from the production manager. We have power, the fixed portion, and then the maintenance, the fixed portion. So we have that, all of that there. So what I'm going to do is to link this up, and then I'm going to copy that down. Control D. Then for my amount, I'm going to link them up like that. So I'll come here and then I'll have that, and then I can copy this down and then also copy this across. Then quickly I can have my totals here. Alt equals to add them together, Control R. So this, I'm just doing addition and subtraction. Okay, so we have alt equals again to add that together, and then I'll have my total budgeted production overheads, and that is going to be equal to this plus the controllable overheads, and that gives me 804,606. Let me wrap that around with this, and then also I'll have this wrapped with my border there. Okay, so this is our annual production overhead, as simple as that. This is our annual production overhead. You can rewatch this video again to get the grasp of whatever I'm trying to bring forward here. All right, so we analyze it according to their controllable and then the non-controllable elements as we have here. And then, as I said, these ideally could be done on monthly or quarterly basis. So if you have had enough information for us to do it on a monthly basis, we would have used that particular method rather than what we are using here. All right, now let's go to the next functional budget here, and that is our selling and admin budget. I can actually come here and copy this, and then copy and paste it here. Okay, so we have that. This is pretty straightforward. What we are coming to do here is that we are going to prepare it. Usually it's prepared by each department head, because okay, so let me quickly change this to the annual selling and admin budget, the annual budgeted selling and admin expenses. Okay, so we've got that, and what's this one is pretty straightforward. Usually what we do is that the department head for the selling or for sales will prepare the selling budget. The one responsible for administration will prepare the administration expenses budget. The one responsible for distribution will prepare the distribution budget, and then we consolidate that together to prepare the budgeted selling and admin expenses budget. So that is what we do usually, but for this, for our purpose, we are going to consolidate it in an annual term as we have here. So what we are coming to do is I'll have two columns. I have a dollar here because the amounts are in dollars. All right, and then quickly let me format these parts as that, and then also expand it a little. Okay, so what we have here is that we are coming to, let's go to our scenario, and then we look at all the items that are relating to sales and administration, and those are pretty straightforward. So what we have here is that since we have the selling and administration, we are coming to try and then put them in within their respective headings. So if it's relating to sales, we'll put it under selling budget, and then if it is admin, we are going to put it under admin. So for that, let's go back to this one, and then I'm going to have selling expenses, and then I also have administration expenses. These are all budgeted. All right, so let's go to our scenario now and then look at what we've got there. So this is stationery. The first one is stationery, and it will relate to admin. We we are going to pick the selling first. So for selling, salaries, we have sales relating to selling, so I will have that, my sales there, and then the amount, I can do Control R to get the amounts there. Then I can cut this and come and paste here. Then what other elements do we have there? We have commissions paid to our people. So I can come here, sorry, so I made a mistake. So we have commission, I'll cut this and come and paste here, and then my commission can come here as commissions. Then alright, so we have our commissions. What do we have again? Prefer to type this manually. So we have what again relating to, so we have car expenses relating to sales, 22,000. So quickly I'll come here, and then I'll have car expenses, and that is equal to, I'm linking the values so that any changes we might make to our data will be updated dynamically. All right, so that is what we have here. And then the next one is advertising, which also relates to our sales efforts. So we have advertising there, and that is equal to 80,000. Is it 80,000? So we have advertising 80,000 there. So we have our total. The total is going to be equal to this or that. So I have my total here. Okay, now for this is supposed to be salaries. Okay, so I'll have salaries here. For office, so quickly let's go here, and then we can pick our salary information for the office. Sorry. So this will be equal to salary information there. So the salary for the office is 28,000 we have there, and then we have stationeries, which are obviously in the office, and that is the 4,000 a year. 4,000. Then we have what again? We have, for finally, we have our miscellaneous expenses, which is office. So, and that is 8,000. So we have here miscellaneous. Okay, and that is equal to 8,000. So I can actually add these together. So I'll have that added together, and then this will give me my total selling and admin expenses budget. So this is the amount you are budgeting, which is equal to this plus this together. So we have that nicely done for us. Let me give it a border here to make it nice. Okay, so we are moving. The last but one budget we want to prepare is the cash budget. Now the cash budget is one of the major budgets, so I'm going to dedicate a whole video on how to prepare the cash budget. All right, I'm going to prepare a whole video on how to prepare the cash budget, so be on the lookout for my next videos on budgeting. All right, but as I promised, the next video is going to be on personal budgeting, how to personally budget your finances, for you to track your personal expenses and all that. Okay, now we have two budgets left. I want to keep this video to this point so that in the next video we are coming to consider the cash budget as well as the master budget. Okay, So in my next video, we are going to consider the cash budget and then the master budget. So we'll end it here. This has been quite a long video, so I want you to grasp all of these so that when you are putting it together within the master budget, you know be flowing with whatever I'll be doing there. All right, so in this particular video, what did we do? We looked at how to prepare the various functional budgets, and as I said, we usually start with the sales budget because it is the principal budget factor or the key budget factor. And what that means is that it sets a limit to the level of activity that we want to undertake within the budget period. So our sales will inform our production will inform the materials we want to use and purchases we want to make for the materials, and then that will also inform how much labor we want to employ, and then also we want to look at how much of our indirect expenses we want to incur to enable our production. So that is it for this video. I will see you in the next